Welcome back to the Wall Street Podcast. Today we're digging into the Wall Street Journal's edition from August 15th, 2025. We'll be distilling some critical financial and economic developments.
That's right. We'll cover the latest on inflation, some interesting investment trends, and importantly, the ongoing impact of trade policies. The aim is clear, actionable knowledge from the latest market intelligence.
Okay, let's start with the macroeconomic pulse. The Journal reported that July's wholesale prices, the Producer Price Index, well, they surged 0.9%.
And that's the sharpest monthly increase we've seen in 3 years. It tracks what producers are paying for inputs, so it's a key signal.
And that complicates the picture for the Federal Reserve, doesn't it? Especially regarding that anticipated rate cut in September.
It certainly does. That 0.9% PPI jump puts pressure on those expectations. We saw Treasury yields move higher as a result.
Making bonds more attractive, pulling some capital from stocks?
Briefly, yes. Though, interestingly, the S&P 500 still notched its 18th record close for 2025. So the rally hasn't completely stalled, but there's a pause.
And on a somewhat related note, mortgage rates.
They dipped slightly, down to 6.58%, a year low. It offers maybe a tiny bit of hope, but, housing affordability remains a really critical issue for buyers.
Right. Now let's pivot to the investment landscape. The Journal highlights Americans putting record amounts of their 401ks into equities.
That's a big trend. Vanguard's data shows workers in their late 30s had, 88% in stocks last year? That's up from 82% just a decade ago.
And Morningstar sees a similar pattern in target date funds.
Yes, particularly for those just starting their careers. Those funds now average about 92% in equities, compared to 85% back in 2014.
So it's a bullish bet across the board, really.
It is. And while it's paid off with the S&P up around 10% year to date, it does mean significantly more risk exposure for individual investors if there's a downturn, much more than in traditionally balanced portfolios.
Okay, let's touch on the corporate and trade realities mentioned. U.S. alcohol exports to Canada, those have taken a big hit.
A dramatic hit. Down 62% for spirits, 67% for wine since early this year. That's due to the ongoing trade battles. We're talking over $173 million in lost revenue for the industry already.
And it's not isolated, is it? Other companies are feeling this.
Definitely. The Journal mentions Rivian, the EV maker, Tapestry, which owns Kate Spade, and even Deere. They're all pointing to tariffs as major headwinds impacting revenue, impacting profits.
And then there's the Eli Lilly example, raising Mounjaro prices in the UK.
Right, and the stated reason is interesting. Aligning with the Trump administration's goal of lowering U.S. drug prices. It shows how these domestic policy aims can have, global ripple effects.
Okay, let's dive a bit deeper then. First module, inflation and the Fed. That July wholesale price surge. What does that sustained pressure signal beyond just the immediate Fed decision, thinking about corporate margins, consumer costs long term?
Well, a sustained PPI jump, like 0.9%, directly squeezes businesses. Higher input costs mean thinner margins. Eventually and typically, companies have to pass those costs along.
So higher prices for consumers down the line.
Exactly. It points towards potentially persistent inflationary pressures, which could, dampen economic growth even if the Fed tries to navigate carefully. It's a challenging balance.
Module 2, 401k risk. This record equity allocation, especially in target date funds, how does it change the game for retirement planning? Is it shifting the traditional ideas of long-term investing?
It fundamentally shifts the risk profile. Traditional diversification is giving way to a more concentrated bet on continued stock market growth.
So your retirement savings become much more tied to market swings.
Precisely. Far more sensitive to short-term market volatility than historically. It means your financial future requires perhaps a more active understanding of market cycles and potential downturns. The set it and forget it idea is riskier now.
Okay, third module, tariffs. We see the direct hit on alcohol exports, the Eli Lilly pricing strategy. How do these things cascade? How do they reshape global supply chains and ultimately market competitiveness?
It goes beyond just the initial sector's hit. Tariffs force widespread adjustments. Companies rethink global pricing, like Lilly. They reevaluate supply chains, maybe look for alternative sources or markets.
Which can shift competitive landscapes entirely.
Absolutely. Industries might see shifts in demand, alterations in who the key players are internationally, and these costs, whether through direct price hikes or reduced product availability, they eventually find their way to the consumer, impacting overall market efficiency.
So let's bring it all together. What does this mean for you listening right now?
Well, first, higher wholesale prices often foreshadow increases in consumer goods. So watch for potential price bumps on things you buy regularly.
And your retirement savings.
They're significantly more tied to stock market performance now. Your personal strategy, your understanding of risk, it's become even more critical. That heavy equity exposure needs careful consideration.
And housing.
Despite that small dip in mortgage rates, affordability is still a major hurdle for many. That 6.58% is still historically quite high, and house prices haven't come down enough to compensate for many people.
It really paints a picture of how interconnected everything is. Wholesale prices, investment trends, trade policy. It all shapes the market and your personal financial world.
Exactly. These aren't just abstract data points. They directly influence your financial outlook, your planning.
So the real takeaway isn't just what happened.
No, it's prompting a further thought. Given that your retirement nest egg might be more exposed and everyday costs could be creeping up, what adjustments should you consider making to navigate this landscape? That's the key question to ponder.